Alrighty, why don't we get started? Well, welcome everyone, and thank you for joining our presentation today. Today we'll be covering practical investing strategies for busy professionals. And our goal with the presentation today is to provide simple, actionable ideas that can make a meaningful difference over the course of your investing lifetime. Just a quick introduction to myself. My name is Nick Fameree, and I'm a wealth advisor here at Curi Capital. My day-to-day focus is on helping clients in making informed financial decisions and supporting their financial success. And while every individual's goals is a little bit different, the strategies that we're going to be talking about today will cover and apply to most busy professionals, regardless of their investment experience. I'll be covering some questions that were submitted in advance at the end, but if at any point you have any questions, please type them into the Q&A, and we'll cover as many as we can towards the end. All right, so our agenda for today, we'll start by talking about how to build a financial foundation. Then we'll cover how to tax efficiently invest and what investment vehicles can help with that. Then we'll cover some investment and saving strategies that are common amongst busy professionals. And then we'll wrap up by talking about key takeaways at the end. So to start, we'll talk about building a financial foundation. So there's three key components that are really important in building your financial foundation, starting with keeping an emergency fund. So when we think about keeping an emergency fund and how much to keep in there, we generally encourage between 3 to 6 months. So if you're a single income household or a dual household with a single income, we encourage keeping around 6 months worth of living expenses in an emergency fund. The reason why is if you were to lose that income at any point, there's no income and we have nowhere to pay our living expenses from. And so we like to keep a bigger safety buffer. If you come from a single household that has more than one income or a dual household with dual incomes, we tend to recommend closer to 3 months because even if you were to lose one income, you still have a small safety buffer, but you still have one income. Next is paying off high interest debt, which we generally classify as anything above 6 to 8%. The reason why is because you get a more stable return on paying off that debt than you might see in the market. And while that's a general guideline, some people are more comfortable paying down all of their debt before they invest, which is also perfectly fine as well. Last, we have making sure you have adequate insurance. We think about insurance that's health insurance, disability, umbrella coverage, life insurance. And the reason there, even though each of those insurance types is a little different, the reason why is that it avoids any unexpected large expense that you would have to pay out of pocket that could essentially derail your savings and investing plan. So that's what we hope to avoid by having all that insurance coverage in place. When it comes to investing tax efficiently, we think specifically about what types of investments and investment vehicles can help us do so. So to start, the first place we encourage folks to invest is to contribute at least enough to their employer's retirement plan, if they have one, to receive the full match. And the reason why is because if you're not doing that, you're essentially leaving free money on the table. If you have the ability to save on top and save additional dollars on top of your match, we also encourage that as well. Another vehicle is a health savings account, if you're eligible for one, which would require you to be on a high deductible health plan, or a flexible spending account if you're on a PPO. So your ability to save to these two vehicles depends on what type of health plan you're on. But the reason that these accounts are so beneficial is because they're triple tax advantaged. So you get an upfront tax deduction for any contributions you make. Your dollars grow tax deferred, and the dollars come out tax free if you use them for qualified medical expenses. So again, each is a little bit different and has its own advantages and disadvantages, but another really powerful account. Next is maxing out or saving to a traditional individual retirement account or a Roth IRA. A little bit different between the two there, again, depending on what makes the most sense for you. A traditional IRA, you make contributions with pre-tax dollars where you get an upfront tax deduction for those that you put in. And a Roth IRA, you pay the tax up front. Those dollars grow tax-free and then also come out tax-free in retirement. And so when we think about when a traditional IRA would make sense or when a Roth IRA would make sense. If you're in a low income bracket today and you anticipate being in a higher income bracket in retirement, a Roth IRA generally would make more sense for you today. If you're in a high income bracket today and think you'll be in a lower income bracket in retirement, a traditional IRA might make more sense for you today. Then the last account that we encourage folks to save into is a taxable brokerage account. So it doesn't offer the same tax incentives as some of the accounts above, but it's another good place to save and invest money and allows a little more flexibility than some of these other accounts do in terms of what you can withdraw the money for. As your income is growing, we encourage folks to increase their savings rate over time. So our belief is that your savings rate is one of the biggest drivers of your wealth, specifically during your working years, even sometimes more important than the investments that you're selecting. And one strategy that we encourage is that when you get a raise or a bonus or your income increases in general over time, we encourage you to revisit your savings rate and increase that before you increase your lifestyle and your living expenses. And another strategy for this is to consider an automatic annual increase on your 401k or your employer plan contributions, which most plans allow today. So at the beginning of every year, your contribution percentage could go up 1% or 2%. And as you can see in the graphic below, even those small increases today can have a meaningful impact over time. So using our hypothetical example here in the graphic of a starting salary of $75,000 with 3% annual raises and a 7% annual investment return, a 1% increase in your savings rate today could lead to 12% more in savings over a 10-year period. If that's at 2%, it could lead to a 27% more savings over 10 years. And finally, at 3%, a 46% more savings over a 10-year period. So as you can see, the compounding effect of the small increases today can lead to a meaningful impact over time. Another thing that we encourage is keeping your investing simple. Investments do not have to be complicated. And in fact, many of the successful investors that I've seen and met only own a handful of broadly diversified funds. And so a sample portfolio that a client of mine is in is exactly this: a US total stock market fund, an international stock market fund, and a US bond market fund. And even though they only own 3 funds, they're broadly diversified and they own thousands of underlying companies. Another way to keep your investments simple is to automate your contributions. So this could be making regular 401k contributions every time you get paid, or contributing the same amount to a traditional IRA or a Roth IRA every month. By automating these contributions, you're taking a set it and forget it approach. We also encourage that with your investments as well. So most custodians today will allow you to automatically invest those monies into funds like this when you make the contributions, which can be really powerful, specifically for busy professionals who aren't going to have the time to necessarily do that on their own every time they make a contribution. Our belief is that your asset allocation is the primary driver of your returns, even more important than the investments that you select over a long-term period of time. So your mix of stocks, bonds, and cash is going to drive most of your investment experience. Stocks are more volatile, but they offer a higher return potential, whereas bonds are less volatile, provide more stability, but have a lower return potential over time. So for someone who has decades until retirement, a young investor, many investors that I come across hold more in stocks and bonds. As retirement approaches, we gradually look to increase bond exposure as it can reduce volatility and can reduce your overall portfolio risk as well. Time in the market beats timing the market. So trying to predict market moving events and market crashes is nearly impossible and usually hurts your investment returns over time. So rather than trying to chase performance and time the market, what we encourage is staying invested through both the ups and the downs. And data shows that investors have been historically rewarded with higher returns in that case. And so how we do that is investing consistently every month in some of the vehicles that I talked about on the previous slides. Keep investing during market downturns, which is a really important component, and thinking in decades, not months. Investment fees are also a very important component of your overall long-term investment returns because fees compound just like investment returns do. And so as you can see in our graphic here, a hypothetical example over a 30-year period on a $100,000 investment at a 7% annual return rate. If we have a very low fee of 0.03%, which you might find in a low-cost ETF or an index fund, you'd pay about $9,600 in investment fees over that 30-year period and keep $761,000 in your investments. Whereas if you owned a higher cost, maybe mutual fund at 1%, you'd pay $316,000 in fees over that 30-year period and only keep $453,000 in investments. And so that's a really powerful example of how lower fees today can mean a significantly larger portfolio for you tomorrow. And so what we encourage there is to always check the expense ratio and the trading costs for any investments that you buy and continuously revisit those years over year as they can change. All right, so in conclusion, some key takeaways today are to save consistently and start early, invest in low-cost, diversified funds, maximize the tax efficiency of the types of accounts that you're investing in, and lastly, stay disciplined and think long-term when it comes to your investment approach. All right, so with that, I'll answer a couple pre-submitted questions we have, but if you do have any questions, feel free to put them in the chat and we'll get to as many as we can. All right, so the first question that we received was, how do you determine whether someone has enough in emergency savings? And so I did partially answer that question in the 3 to 6 month time range. It's really dependent on your comfortability. So if you feel like you have a stable income, you get paid every 2 weeks, you have good job security, we can tend to shift more to that 3 months, but you might feel more comfortable having a little bit more. Whereas if you're someone who gets paid on commissions, might not have a ton of job security, you're the only one in the household with an income, that's where we want to lean closer to that 6 months. So essentially what it boils down to is the less stability in your position, the less stability in your income and your expenses, we want to have more in that emergency savings bucket. Next question here is, how often should I revisit my investment mix? That's another great question. I generally recommend that clients look at their investment mix at least annually, and oftentimes at the beginning of the year. It's a really good time as we're looking ahead to the year ahead, revisiting our goals, things like that. It's a really good time to review our investment mix and see if any of our goals have changed, and if as a result of that, we should change our investment mix as well. So I would generally say at least once a year and do it at the beginning of every year to see if anything needs to be changed. All right, our next question is here, at what income level does it make sense to shift from Roth to traditional contributions? So as I said earlier, when we think about doing Roth versus traditional contributions, we generally think about it of what level your income is at today versus where it will be at in retirement. And so if you're in the lower tax brackets today, call it the 0%, the 10%, the 12% tax bracket, and you feel like you'll be higher than that in retirement, that's generally where we would recommend you make Roth contributions. If you're in those middle tax bracket, the 22 or the 24%, that's really in the range where we could do either, and we actually see clients oftentimes split down the middle. So they'll make 50% of their contributions to Roth, 50% to traditional, so they get the benefit of both. And if you're in the highest income tax brackets, the 32, the 35, the 37, that's where we generally see more traditional contributions being made today to get the upfront tax deduction, with the idea that we'll be in a lower tax bracket in retirement than we are today. So it's all dependent on the person, and we see a varying mix amongst all of our clients and folks that we talk to. But that's the general guidance that we have around Roth versus traditional IRA contributions.
Nick, we have a question in the chat, and it is, if you suddenly received a large bonus, how would you decide where to allocate it?
It's a great question. I think I would start by just revisiting any short-term goals that I have. So if we have things on the horizon, like maybe a house purchase or paying off debt or a home improvement project that we have, I would start by thinking about whether any dollars from that bonus should be allocated to that. There's no short-term goals that we have on the horizon. That's where we can think about maybe longer term investments, thinking about putting that in things like our retirement account or saving for a future goal down the road. So that's where I would start. And then dependent on the answer to that is what's going to determine where to invest those dollars. So if there's a shorter term goal, like a 12 to 24 month period, we'd look to keep that in cash or in like a short term bond. So that way we're not taking on a ton of volatility, knowing that we're going to need those dollars sooner rather than later. If it's in for an investment down the road, say for retirement, that's in 10 to 20 years. That's where we can look to take on more volatility and invest it in things like stocks. Any other questions that we had, Maury?
Nope.
Okay, sounds good. Well, thank you everyone for joining today. If today's discussion got you thinking about your own financial goals and needs, and you'd like to discuss them further, I'd be happy to set up time. You can scan the QR code here directly or reach out to me. Again, thank you all for joining so much.